An introduction to Elliott Wave Theory. Elliott Wave Theory is one of the most exciting of all technical analysis tools. Once you see how this works, don't be surprised if it changes the way you trade forever. While many traders complain about not making any money, there are some who do well, and these traders will often be talking about what wave we are in. Elliott Wave is a predictive tool which can be extremely valuable. So let's take a look at Elliott Wave Theory and see how it works. Many people feel intimidated by it, and those who publish information on it may be partly responsible for this. They make it look more complicated than it really is. So much so that some claim that it doesn't work. It can be rightly said that not all markets unfold in perfect Elliott Wave patterns, and here we would include individual company stocks because these react to news events. However, if you're interested in Forex or stock index options trading, we can safely say that the price action will exhibit Elliott Wave patterns most of the time. This being the case, Elliott Waves can help you know in advance where the markets are going. Having said that, may we suggest that you don't limit your chart analysis to Elliott Wave Theory alone, but use it in conjunction with other chart analysis that confirms your expectations. So let's look at Elliott Wave Theory, trends versus counter trends. Elliott Waves help us to recognize the difference between the prevailing trend and a counter trend. We call moves in the direction of the prevailing trend impulsive moves, and the moves against it the corrective moves. Under Elliott Wave Theory, bull trends have higher highs and higher lows. And here's the important part. For it to be a trend, the lows do not overlap the previous highs. Not only so, but a trend tends to unfold in 5 waves. Notice the horizontal line in this chart. The low at point 4 doesn't come down lower than the previous high at point 1. If it did, then it would be an overlapping wave, and this would disqualify the chart pattern from being a trend. When this happens, the corrective wave, that's wave 4, will be called a counter trend instead. So we've defined what a counter trend is, as opposed to a corrective wave. When we observe a counter trend, which usually follows an Elliott Wave trend, we can often break this down into 3 sections, which we will label A, B, and C. If there are more than 3 sections, then it is called a complex counter trend. Once you can see that there is a complex counter trend in progress, it is best to wait until it is completed before looking for a new trend. Otherwise, your risk of loss becomes higher. Once a counter trend finishes, you will often witness the continuation of the previous trend in a further 5-wave pattern. Here, we can see how a downward trend plays out with a 5-wave pattern, followed by an ABC counter trend. Note how the C point on the counter trend overlaps above point 4 on the downward trend. This is what qualifies it as a counter trend and not a corrective wave. So let's look at Elliott Wave Theory and some further rules. Wave 2 may not retrace beyond the beginning of wave 1, as you can see in the example to the right. The maximum Fibonacci retracement allowed for wave 2 is 78.6%. Wave 3 may not be the shortest of the 5 waves. Some say that wave 3 should in fact be the longest, and it usually is. The wave 4 retracement may not make a close that overlaps the end of wave 1, as you can see with the circled number 4 to the right. This will generally not be an issue if wave 3 is the longest wave. Now, some rules of ABC counter trends. There are 4 simple rules for an ABC correction. 1. Wave B may not trade beyond the beginning of wave A. Number 2. Any price action that goes back into the range of the potential wave 1 or point A would void the new extreme as a wave 3, as you can see to the right. Rule number 3. Wave C must trade beyond the extreme of wave A. Here's another example of a failed ABC correction. This is how it should look when C goes beyond A. Rule number 4. Any price action beyond the extreme of wave B confirms that the simple ABC countertrend is now complete. Let's look at Elliott Wave Theory and subdivisions. You will find that as you observe Elliott wave patterns, that inside of each wave a subdivision on a smaller time frame exists. This is how it works. Waves 1, 3 and 5 are the impulsive waves, that is, in the direction of the trend. And each of these in turn tend to subdivide into a further 5 waves on a smaller time frame. Waves 2 and 4, being the corrective waves, tend to subdivide into either 3 ABC waves or a complex countertrend. Within these patterns, corrective waves A and C tend to be impulsive against the larger trend, and they in turn will subdivide into 5 wave trends when you zoom into a smaller time frame. This is very important to understand as you look at patterns forming over multiple time frames. Once a 5-wave pattern has run its course, it should be followed by a correction that is greater in time and price than any correction, that is, wave 2 and 4, within the original 5-wave trend. This is how the markets work, and the trick is being able to identify the patterns. Not only so, but you'll also see patterns within patterns. Let's have a look at using Elliott waves in conjunction with Fibonacci ratios. This is where Elliott wave theory gets really exciting. The great thing about Fibonacci patterns is that they allow us to set predictive price targets. When we combine Fibonacci ratios with Elliott wave patterns, we have the potential for continual trading profits with remarkable precision and low risk. Fibonacci retracements. These are drawn from the obvious highs and lows within an Elliott wave pattern. Wave 1 usually doesn't have any projection points simply because this is your starting point and you don't have any retracement areas yet. It is possible that there might be a target within the larger pattern, however. Wave 2. Since this is the corrective wave, the Elliott wave projection for where this wave will retrace to is either 50%, 61.8% or 78.6%. The minimum is typically 50%, although you will sometimes see a retracement of only 38.2%. Wave 3. This is the one you want to be in, as it typically is the longest wave. Now that we have points 1 and 2, we are in a position to project a price target. This is what we do. We measure the length of impulsive wave 1 and then project a percentage of wave 1 from the end of corrective wave 2. Since wave 3 is the longest, it would normally be 100% or 161.8% of the length of wave 1. In a less likely scenario, the projection would only be 61.8% or as great as 261.8%. An alternate way of determining where a wave 3 will end is to go to a smaller time frame and identify the Elliott wave patterns there. Wave 4. Being a corrective wave, the typical expectation is a minimum retracement from wave 3 to 38.2%, as you can see on the chart to the right. Sometimes it will retrace to 50%, or even less likely, 61.8%, which is the maximum allowed. Wave 5. This one is calculated a bit differently, as it doesn't usually go very far. Here's what we do. We take the whole distance between the beginning of wave 1 through to the end of wave 3, then from the end of the corrective wave 4, project another 38.2% of that distance. It could go as far as 61.8%, but this is less likely. Sometimes a wave 5 can complete just beyond the end of wave 3. The momentum is declining by then. Being able to identify how Elliott Wave Theory works in the financial markets and then combining this with Fibonacci projections allows any trader to confidently set profit targets and stop losses. Having a set and forget strategy that really works can really make a difference to your trading experience.